Hey everybody, welcome to today's Bobcast. I'm Jesse Thompson.
And I'm Bob Benny. We're both certified financial planner professionals with Bob Benny Wealth Management right here in Lincoln, Nebraska. And we're doing our weekly Bobcast today. And what's the Bobcast about today, Jess?
It's a mid-year market check-in. So we're about halfway through the year, and we just kind of wanted to jump on and let you guys know what's been going on with the market through the year so far and why, and kind of what we think might happen for the rest of the year for what that's worth.
Right. So right now, year to date, we're up just a little bit in the market year to date. The S&P 500 is up 1.72% year to date. This is as of June 17th, Tuesday, June 17th. What's the NASDAQ up, Jess?
The NASDAQ is up around 1%.
Yeah. And that doesn't sound that great, but it's kind of that great.
Where it came from.
Considering where it came from, at the after a bunch of fear, just fear, because the market was dropping because of fear earlier in the year, and unfounded fear, it turns out. The market, the S&P 500 at its worst point in April was down about 15%.
NASDAQ was down probably about 18.
Yeah. And
somewhere
so,
close to that. And so it's came back and gained.
And so, and it makes sense that it should go back up, because the real value of these companies is based on their earnings. And all along, these companies, not all of them, but the majority of companies have been growing their profits and making more money. And the more money, the more profit or earnings that a company makes, the more it's worth. That's just the fact of life. That's how it is with this company, with the car wash across the street, with a grocery store, with any kind of a business. The more money you're making, the more money, and it makes sense. And so, but you have the pressure, I would call it pressure of earnings pushing the stock market up, but then you have fear coming in, whether it's driven by the news media or whatever the fear is, world circumstances, whatever, fear will cause the stock market to go down. Basically, people are fearful, so they want to sell. You got more people selling than buying, prices go down. But we still have things going on, right? We still have concern about tariffs going on. We have concern about world events going on. We have concern about domestic events going on. We have concern about the Middle East going on. And yet the stock market has recovered, and it is up a little bit for the year.
And that's part of the proof of why the dip that happened in about April, that was all you would see in the news was stuff about tariffs and how tariffs are going to cause a recession and crash the stock market and all these things. And the tariff situation is not over by any means. There's been some deals made, but there's still a lot that needs to be sorted out with that. There's not a neat bow tied on that situation at all, yet the market has recovered from it. So that also kind of goes to show that there was an illogical dip that happened. Yeah. And that happens. That's very normal for the stock market.
Right.
It's very normal for that to happen one time a year, for it to go even deeper. Right. Than 15%. So
and yet it's gained that all back, mm-hmm. and is up. The broad market S&P 500 is up 1.72% for the year, and that's. Here we are, June 17th. We've got some significant political unrest going on in our own country. We've got global political unrest going on. We've got, the Iran-Israel thing going on, the Israel-Gaza thing going on, Middle East events, still have the Ukraine-Russia, all that stuff still going on, and yet the stock market's still going up. And it's going up because of earnings. And the companies are forecasted to. I mean, they're pretty confident.
So when these companies on the S&P 500, they report their first quarter earnings, a lot of times they'll forecast what they expect the earnings to, based on this first quarter and how it's been, what they expect to happen for the rest of the year,
right,
for their profits and if they need to be adjusted and things like that. Well, by and large, the number of companies that gave forecasts for the rest of the year for their earnings, they, for the most part, like literally there was like 250, and by and large the majority of those said that they either expect their earnings to stay the same as what they had thought they would be before all of this tariff talk, or to go up. And so that's part of why we think that the profitability and the prices of the stock market will also continue to go up. While there might be some volatility surrounding different things, like if there's different news stories about tariffs or about interest rates, or if things happen, like if the U.S. enters this situation with Israel and Iran, that might cause some volatility too, and there might be a dip. And historically, actually, whenever that happens, whenever there's war that breaks out, and this just happened on Friday when we heard about the bombings that were happening with Israel and Iran, the market dips right upon the news of that. And we saw that happen with Russia and Ukraine just a couple of years ago. And historically, you can look back at all of those world kind of war situations and events, and the exact same thing happens. There's a temporary dip right away because people are freaked out, and then the market goes back up. And unfortunately, actually, war is actually good for the companies on the stock market. By and large, it's a kind of a money-making thing.
Yeah,
so
because there's a lot of manufacturing and things like that. So anyway, we are optimistic and confident about the rest of the year because of the earnings, because companies are making money. They're figuring out how to overcome different issues that have gone on with the economy, and that's what capitalism is all about. And we're capitalists, and we're optimistic capitalists. We believe that by the end of the year will end up with an above average year for returns. We're hopeful about that too, but there's evidence that that's a reasonable prediction, being that the average over the long haul of the stock market is about 10% a year. We're optimistic that we're going to exceed that again this year by the end of the year. So thank you very much for watching our Bobcast. If you have any questions or want to talk to us, or have about this or anything else that we do with Bob Benny Wealth Management, you can email us at bob@bobbenny.com or
Jesse@bobbenny.com.
Thank you very much, and have a blessed day.
Thank you.